Welcome to Zing Talk. I'm Matthew Boesler, and joining me today is Vitaliy Katsenelson, Chief Investment Officer at Investment Management Associates and author of the brand new book just out last month entitled The Little Book of Sideways Markets, How to Make Money in Markets That Go Nowhere. Vitaliy, how are you doing today?
I'm doing great, thank you.
Now, in your book, which is just a great read for anyone who wants a clearer picture of what's going on in the face of all this market uncertainty right now, but in your book, your thesis is that we're not in a bull market, we're not in a bear market, but we're in a sideways market right now. Can you give us an idea of what exactly you're referring to when you describe a sideways market?
Think about it this way. When you own stocks in the long run, I'm not talking about days, but I'm talking about months, years, decades. Stock returns could be explained by really just looking at two variables. It's basically their earnings are growing and or contracting, or price to earnings going up or down. So let me put it this way. Over the last 100 plus years, if price to earnings always stayed at 15 times earnings, which is about the average, and then basically we would have no market cycles, and stocks would go up basically 5-6% a year. It would be different from from one year to another, but on average it would be about 5-6% a year, and we would have no bull markets or bear markets or sideways markets. It'd just be stocks would be going up, little by little every single year. What happens, however, investors get over optimistic, and the price to earnings goes to above average level. So it goes to about 15. It goes maybe 20 to 25, 30. And when the price to earnings gets when the price to earnings goes up, investors start receiving higher returns than the average. They start receiving 10, 12, 15% returns, and that's when you have secular bull markets. However, when price earnings get very, very high, and they start contracting at some point, and the same human emotion that took price earnings upwards, the greed took it above 15, fear takes it below 15. And so what happens in sideways markets, price earnings are declining and earnings are growing. And therefore, you have basically these two forces working against each other, and markets will go sideways. When I make an argument about sideways markets, there is an explicit assumption that we're going to have earnings growth in the economy over the next decade. Because if you don't have earnings growth, then this is the case when you have secular bear markets. And secular bear markets happen when you have high valuations and decline in earnings. Think about what happened in Japan from 1990 to today.
Right.
They had very high valuations and earnings declined.
And in the book, you say that the current sideways market has all the makings in place to be the longest in modern history. That is some tough talk. Why is that? Yeah,
sure. So what happened? So if you look historically, this sideways market started at the highest valuation ever. So in 1999, S&P was trading at over 30 times earnings. The reason the length of the market, the reason I'm saying that it's going to last longer, because the sideways markets basically, their length is determined by two factors. It's the starting valuation, I guess three factors: starting valuation, ending valuation, and the rate of earnings growth. So my point is this: we're going from 30 times earnings to 10 or 12. I don't know. Okay, and the earnings growth is that's what's going to take us there. So I would be arguing today that earnings growth going forward for the economy in general would be below what it was in the past 10 years. So because the consumers are deleveraging, governments right now they're leveraging up a little bit, but then they'll be deleveraging at some point, and that means low earnings growth. Plus, we're going to have higher taxation because governments are more leveraged. So therefore, we have high valuations and high taxations, low earnings growth, and that's why I think this market may last longer than the ones in the past.
Right, and in terms of the market's current price-to-earnings ratio, we're still in for quite a bit of compression at this point, correct?
Yes, and this is not a simple discussion, because if you look at the forward earnings for the stock market, it doesn't look that expensive. It still trades, 16, 17 times earnings, but it doesn't look horrifically expensive. However, the market only trades at 16 times earnings if those earnings will come through. And my argument is that the corporate profit margins today are making a multi-decade high again. And the high corporate profit margins are not sustainable in the long run. because if one company becomes too profitable, it invites competitors to come in and to compete those excess profits away. So those excess, the high profit margins are never there to stay for a long time. So the true market valuation is actually higher than 16 times. It's probably close to 18, 19 times. That's argument number one. Argument number two, historically, PEs went from one extreme to another. So they didn't just go from above average from 30, stopped at 15, and went back to 25. It just hasn't happened before. So what's likely to happen, PEs will go from 30, below 15 and stay there for quite some time. In fact, if you look at the last sideways market from 66 to 82, PEs spent half of their time at below 15 times. So I don't think overall market is cheap. There are some attractive stocks there that are cheap, but overall market is not cheap.
Right. So we're looking at higher than average valuation right now, but let's talk about earnings growth. We're entering earnings season this week. We just had Alcoa report on Monday. They came in at 21 cents per share, beat expectations. They reported their revenue growth is up 4% year over year. Should we expect to see the continued strong earnings growth we've seen in U.S. equities over the last couple of quarters? And if so, what does this mean for the sideways market?
If you look at the expectations that the expectation that the S&P is going to have earnings of $75 this year, trade-in earnings, $75. So the expectation that yes, we are going to have earnings growth. The problem is though, the earnings growth is taking place when you have a very high unemployment. And a lot of the growth is coming from the fact that basically companies are cutting costs, and then they were laying off people, and they're not hiring people back yet. I have no idea what this quarter is going to be like, or next quarter is going to be like. But my thesis is, it's kind of, when you write a book, you can't really think about 2 quarters ahead, right? So whatever happens this quarter is not going to change this, or next quarter is not going to change the thesis of my book. And the thesis is very simple. Valuations are still above average. We'll get to below average valuations, so the P compression is still there. As price earnings compress, we'll still be in a sideways market because the benefits from earnings growth, either going to be 2% or 3%, is still going to be wiped out by price earnings declining.
Now, we're talking about earnings growth and valuation, but I want to ask you about how the economy factors into all this. We saw an unexpected drop in the unemployment rate last week. It seems as if there are some rays of light to look at here in terms of the economy. Investment professionals seem very bullish right now at the beginning of this new year. We've got the market rallying strong today on news of a very receptive Portuguese bond auction, kind of easing fears in the Eurozone. What are people missing here?
The problem is today is extremely, extremely difficult to analyze the true health of the economy, because we have a tremendous amount of government intervention in the economy. The government is basically spent trillions of dollars on stimuluses, and now Federal Reserve is basically interfering with the long-term rates by buying long-term bonds, and short-term rates are at zero. So my problem with the economy is that here's my analogy. You have an athlete who ran. He fell, broke a couple ribs, but he ran. Okay, so you basically inject a huge amount of steroids into this athlete. And you look at him and he's running, so he seems to be doing all right. So based on, if you look at his vital stats, he seems like to be on top of his game, at the top of his game.
Right.
The only problem is you don't really know, is that the steroids are at work or that's his just true performance. And my point is that there is so much government intervention in the economy today, so much stimulus, that it's very difficult to judge the true performance of the economy. And the reason that matters is because if it's the steroids at work, it's not a sustainable performance. It's not something that you basically cannot bet that it's going to be there tomorrow, because steroids are not a long-term fix, right? They're a very short-term fix. And then as they wear out, as the stimulus ends, basically the economy will come back to its true performance. And I'm kind of just afraid to find out what it is.
Right. And what do you expect the dangers will be in terms of, the Fed's current $600 billion round of quantitative easing? What do you perceive happening as a result of that?
So historically, Federal Reserve controlled short-term side of the yield curve. Okay, but they already took short-term rates down to zero. So what they're doing today, by trying to lower long-term rates, they're basically trying to take people who didn't want to take risk, because they're basically, what they want to do, they want to they want to take long-term bonds to 3 or 2%, and which is going to be basically the rate below inflation, and it forced people who didn't want to take risks to take risks. Like, the danger of that is that basically they're going to hurt people. The reason they're doing it because they're trying to create asset values of stocks, bonds, real estate. But that will be artificial inflation of assets at some point, which at some point will burst. So, the problem is that by doing this, they may also destroy the value of the dollar. Because and if they do that, it means they may get inflation in places they didn't want to get inflation, like commodities. So I think this policy is very dangerous, and I think it's a very as an investor, you have to try to control the urge to speculate, because when Fed's policy basically inflating the riskiest assets. Okay, and therefore the risk assets will go up, and you're going to have the urge to buy them, which is basically kind of urges you to buy something that is already expensive, hoping that it's going to become more expensive, which is not really investing, but it's more like speculating,
right?
Or trading. And investors are not good, either speculators or traders. So I'm afraid that a lot of people will get hurt.
Thank you for listening to Part 1 of Benzinga's Zing Talk interview with Vitaliy Katsenelson, CIO of Investment Management Associates and author of the book, The Little Book of Sideways Markets, How to Make Money in Markets That Go Nowhere. Look for that one anywhere fine books are sold. Be sure to subscribe to Zing Talk in iTunes. You can find a link to do that on the Benzinga homepage. If you like what you hear, give us a good rating and help new listeners find us. The music you're listening to is Beethoven Virus by Banya and is available on the Internet Archive. All Benzinga podcasts are released under Creative Commons Attribution Share-alike 3.5 license, and all other rights are reserved.